Welcome to the taxation review for Chapter 5. Let's just jump right into it. Now in Chapter 5 we talked about capital cost allowance, and capital cost allowance is basically tax amortization. Now we focused on how to calculate capital cost allowance and what to do with the disposition of these depreciable assets. Those were the two main topics we covered in Chapter 5. Now with capital cost allowance, we have to allocate the depreciable assets into classes, and each class has a different CCA rate. Now, the half-year rule applies to most classes. What the half-year rule says is that in the year that you acquire assets, 1/2 of what we call the net additions is not subject to CCA. Now, net additions is basically the excess of any additions to that CCA class deducted by any dispositions. Now, 1/2 of that amount, once again, is not subject to CCA in that first year. We also talked about the fact that CCA is a discretionary deduction. Therefore, a company could take anywhere from 0 to the maximum amount. If a business already has a business loss, or if by taking CCA it could create a business loss, they may not want to do that, because remember, with business losses, they're treated as non-capital losses, and they only carry back 3 years and carry forward to 20 years before they expire. Now, if a company wants to take some CCA and they get to choose from different classes, the best strategy is to take CCA from the lowest rate class, and therefore you save the higher rate class CCA deductions for later years. Now, most CCA is deducted or calculated on a declining balance basis, but there are a couple exceptions, including Class 13 and Class 14. So let's talk about those next. Now, Class 13 deals with leasehold improvements. So for example, if a business leases their head office and they make substantial renovations to that head office, that would be a leasehold improvement. They don't own the building, so they can't take CCA on the building, but because they're making substantial renovations or alterations to an asset they're leasing, they are not able to deduct those amounts all in one year. They have to allocate it to Class 13 and take CCA. Now with Class 13, it's done on a straight line basis, and the CCA is calculated by taking the lesser of two amounts, 1/5 of the capital cost, or the capital cost divided by the lease term plus one renewal period. Now with Class 13, the half-year rule does apply, and so this is a calculation where it's done differently from declining balance. You have to figure out the lesser of those two amounts, and in the first year, the half-year rule does apply. Now, another common exception to declining balance is Class 14. Class 14 deals with limited life intangibles. Now, they're done, CCA is calculated on a straight line basis over the legal life. Now, once again, with Class 14, it's a little bit different, where CCA is calculated on a pro rata per diem basis. What that means is the half-year rule and the short fiscal year rule does not apply. Now, the short fiscal year rule basically would be the first year of a business or the last year where they don't have a full fiscal year. And the half-year rule once again applies when you add assets into a particular class. With Class 14, for example, when an asset is added to Class 14, it's basically calculated once again over a straight line basis over the legal life, and it's prorated based on the number of days that the asset was in use for that particular year. So just keep in mind that Class 13, Class 14 are exceptions to the declining balance calculations for CCA. Moving on to the next slide, we're going to talk about the disposition of depreciable assets. Now, this is a particularly challenging topic for most students. The basic rule is that when you dispose of depreciable assets, you deduct from the CCA class the lesser of the proceeds of disposition or the original capital cost. Now, when you do that, there could be a positive balance that remains in that CCA class. Now, if there are assets still remaining in that CCA class, you just continue taking CCA. Pretty straightforward. Now, if there's a positive balance and there are no assets in that class at the end of the year, you have what's called the terminal loss. If you have a positive balance remaining and you've sold all of those depreciable assets, that means you have not taken enough CCA before you dispose of those assets. So you have a positive amount. You get to deduct that full amount from your income. And once again, that's called the terminal loss. And that's going to reset the CCA balance in that class to 0. Now, if you have a negative balance at the end of the year, that's called recapture. So you dispose of an asset in a CCA class, you deduct the lesser of proceeds or the capital costs, you have a negative balance. If you don't add any more assets to that class by the end of the year to bring that negative amount back to a positive amount, then you have to add that negative amount back into income. That's what we call recapture. So think about why you have a negative amount. You add the capital cost to the CCA class, you continue deducting CCA every year. When you sell it, you deduct the lesser of proceeds and capital cost, and you have a negative amount. That means you basically took too much CCA. And so you have to add that negative amount back into income to reset that balance to 0. Now, when you dispose of a depreciable asset, there is a possibility that you might have a capital gain. You sell it for more than what you bought it for. And remember that 50% of capital gains are taxable. Now, also remember what we talked about in class is that when you dispose of depreciable assets, there is never a capital loss possible. Moving on to the next slide, we talked about this new Class 14.1. Class 14.1 was introduced in 2017, and it relates to unlimited life intangibles and also goodwill. Now, the way that this class works is pretty straightforward. It's very similar to the way we calculate CCA with declining balance classes, and this is a 5% declining balance class. All you do is whenever you acquire unlimited life intangibles, you add the amount to class 14.1 and you take 5% amortization on a declining balance basis per year. The half-year rule applies, so nothing different there. And also when you dispose of class 14.1 assets, you deduct the lesser of cost or proceeds. And once again, if there's a negative balance, that means you took too much CCA, you have recapture, you add it back to income. Now, one of the differences is that if you have a positive balance at year end and there are no assets remaining in the class, you have to continue taking CCA. You do not get a terminal loss. So that's the one difference with class 14.1. If there's a positive balance at year end and there are no assets remaining in the class, you do not get to take a terminal loss. You just continue taking CCA as long as the business continues to operate. Now, because class 14.1, moving on to the next slide now, was introduced in 2017, there are these transitional rules. Now, prior to 2017, when we had unlimited life intangibles and goodwill, they were called cumulative eligible capital. Now, the rules prior to 2017 said that if you had cumulative eligible capital, you would add 3/4 of the cost, 75%, to the CEC account, and you would take 7% amortization every year. So quite a bit different from the new class 14.1. Prior to 2017, as a recap, you add 3/4 of the cost of your unlimited life intangibles or goodwill into a CEC account, and you take 7% amortization or the CEC amount per year. Now, when we moved into 2017, businesses that had a CEC balance remaining at the end of 2016 would just transfer those amounts into class 14.1. Now, with the amount that was transferred over, for the 10 years after 2016, businesses could take CCA equal to the greater of 7% of that pre-2017 amount, just like what they did prior to 2017, or $500 per year. Now, keep in mind, this is the greater of these two amounts. And what this is doing is saying that if a company had small amounts in their CEC balances at the end of 2016, rather than just make them stretch it out by taking 7% per year, if it's $500, they can just deduct that full amount. Also, with disposition of pre-2017 CEC assets. So if a company had unlimited life intangibles or goodwill prior to 2017, and that balance carried over into 2017, and they disposed of those assets. There's basically a two-step process. First of all, to the CEC or to the class 14.1, they would have to add the lesser of 25% of the proceeds or 25% of the cost. What that would do would be to bring that particular asset that's being disposed of back to the 100% amount. Remember, we said that prior to 2017, 3/4 or 75% of the cost of CEC assets would be added to the CEC account. Well, when we dispose of them in 2017 onward, we add 25% of that cost or proceeds back to once again bring it back to the 100% figure, and then we deduct the lesser of proceeds or cost. And we could have recapture, and we could also have capital gain, just like we did with other class assets in other classes as well. Moving on to the next slide, there were some other topics that we focused on in Chapter 5. We talked about mandatory versus optional separate classes. Now, in some situations, company must separate certain assets into separate classes. For example, if a company has, or if there are separate businesses, for example, if there's an individual that operates different businesses, those assets, those depreciable assets, will have to be tracked in separate accounts. Rental properties that have a cost of greater than $50,000 allocated to a separate class 1, and also luxury cars over $30,000 are allocated to a separate class 10.1 as well. Now, there's also optional separate classes, and we focused on assets subject to high rates of technological obsolescence. So, for example, if there's photocopiers with a capital cost of $1,000 or more, a business could separate those into separate classes. And the reason that this election would be beneficial to businesses is that if there was a terminal loss when they sold, for example, that photocopier, they could deduct that amount right away because that photocopier is in a separate class. One of the most challenging areas in Chapter 5, to wrap up, is the disposition of depreciable assets and the impact on the CCA class. Now remember, once again, when an asset is disposed of, one would have to basically deduct the lesser of proceeds or costs from that particular CCA class. And there could be a possibility of recapture, and there could also be the possibility of a terminal loss. And if the asset is sold for more than the capital cost, there could also be capital gains as well. So that would be an area that I always recommend students review before their next midterm. And remember that all material in Chapter 5 is examinable. That brings us to the end of the Chapter 5 tutorial. Good luck with your studies.